Hello, and welcome back to the channel. My name is Zach Collins, and this is Financial Education. Today, I'm going to be talking about insurance. I know it's a bit of a boring topic, and I'm not going to be trying to sell you anything. We're just going to go through the definitions of the four main types of personal insurances, and why you would have them, and what they're used for. If you're not familiar with what these personal insurances are, I'm talking about life, TPD, trauma, and IP insurance. Let's start with the most obvious one, being life insurance. It's exactly as it sounds. If you were to pass away, whoever you nominate as your beneficiary will receive this lump sum insurance payout. Now, there is also cover that you can get for terminal illness. That's where you get the payout while you're actually still alive. This, however, is not standard, and so you'll need to specify if you want this option, as not all insurers offer it, or they might actually charge you more. So how can you hold this cover? You can hold it either through super or personally. If you were to hold it through super, you can actually get a tax deduction for the premium payments you make. Now, this does assume that you pay for the premiums into your super account, and it's not that you're just drawing down the super balance to fund the insurance. One thing with this is that you do need to bear in mind that if you are already contributing to the contribution cap of $27,500, you can't claim any more. This is more of an incentive for those that are only receiving their superannuation guarantee and their surplus concessional contributions. You might be thinking to yourself, why would I get life insurance? So the general idea of life insurance is to essentially cover for the earnings that you're not making. So if you're single and have no dependents, then you probably don't need cover, as you have nothing really to provide for. However, if you have a spouse and kids and a large mortgage, you should probably consider what would happen if you were to pass away. Would your spouse be able to continue working and pay for the home and the kids' schooling and extracurriculars and whatever else your family normally spends money on? The amount that you would insure for is 100% up to what you think is necessary. I've seen some insurance policies where the person insured want to pay off all their debt and provide enough money to keep the family going and allow their spouse to choose to not work. Others where the spouse will continue working. Some where the kids go to private school. Others where they go public. There are a lot of different factors determining how much cover you get, and it's important to look into it because unfortunately, and look, this might sound a bit morbid, but sometimes you never know when your time is up. So income protection is up next. It's also called salary continuance. And again, it's supposed to be exactly as it sounds, a continuation of your salary or protecting your income. So income protection is one of the most important types of insurances out on the market, because if you're in your working stage of life, most people are living pretty close to the edge, and a month or two with no income could be enough to push most people over the edge into defaulting on loans or potentially taking out lots of high interest debt. So what income protection does is it will ensure if you're unable to work due to sickness or injury, you still get paid. Now, this doesn't cover redundancies or quitting, it's just for sickness and injury. Now, the amount that you get is not actually your full salary. So insurers will only allow you to insure a portion. Some insurers will allow you to cover about 75%, others only 70%, and again, others will do 70% for the first few years, and after that, it will drop down to 60%. It should be pretty obvious that the more of your income you want to cover, the more expensive the policy will be. So the 75% policy will be the most expensive, whereas the 7% one that drops down to 60% will be the cheapest. There are really two types of policies. One is no longer available here in Australia, and that's agreed value. The only option currently available to purchase is called indemnity value. So what's the difference? Agreed value will give you a guaranteed payout. If you're insured for $10,000 a month, and you can prove that at some point in time you're earning enough that 10K was about 75% of your income, then you can get that, even if you're earning a lot less now. Indemnity value, however, will only pay you based on your current income. If you were insured for $10,000 because at the time you were a doctor, but you've changed fields and now you're earning much less, the insurance company doesn't care. They don't care that you're paying premiums for higher payout. They're only paying you 75% of your current income. That's why it's really important to monitor your cover reasonably frequently, especially if you drop your income, because you'll be paying for cover you won't get paid out for. At the same time, you need to consider that it may not be best to reduce the cover. There could be increased underwriting of the policy if you ever decide to increase it back up in the future. There are also different periods that you can get the insurance paid out. The most common one, if you hold it through super, is about a 2-year period, which means for 2 years you will get that percentage of your income. There are longer ones which come up to 5 years, and there are even further ones that go up to age 65. There's a few key things about income protection cover before we move on that I just need to emphasize. Firstly, this is that it's the only insurance on the list I'm talking about today that is personally tax deductible. You can, however, hold a policy through super, as I mentioned just before. Each policy will have a waiting period, and this can be anywhere from 1 month to multiple years. And in this waiting period, you won't get paid. If you go back to work at any point during this waiting period, you're no longer eligible to claim on the policy. When it does come to the waiting period, you need to make sure that you read the policy thoroughly, as I've seen some where you need to use up all your annual and sick leave before the waiting period even commences. So if you have 6 weeks of annual leave and 4 weeks of sick leave built up, that's 10 weeks you need to take off work before the waiting period even starts. And by that time, you might even be fine to go back to work anyway. Trauma is the only insurance policy on this list that you can't hold within super. So trauma is if you get a major illness, think of something like cancer. So the reason you can't hold it in super is because you need to meet a condition of release in order to access money in super. A condition of release could include incapacity to work. If you have cancer, some could be really bad and lethal, others not so much. You might be able to completely function like normal, except you just get the insurance payout. Because of such a large differential in outcomes with the one insurance policy, they've decided that it's best that trauma can only be purchased outside super, and also that it's not a deductible insurance policy. Finally, we have TPD. So TPD stands for Total and Permanent Disablement, and along with life cover, it is one of the most common insurance policies that people have. This is purely because it's included as a default insurance that people get when they open up new super accounts with industry funds. In order to get a TPD payout, you need to really injure yourself, hence the name Total and Permanent Disablement. The problem with that is that different policies have different definitions, and some differentiate between whether you can go back to your current job or whether you could work any job at all. If you are a construction worker, for example, and you break your back, you're probably never going to be able to get back into your old job. However, if your policy says any job, you could probably still work at an office job, for example. If you look at the webpage that I've got linked in the description below, you'll see that TPD is the least successfully claimed type of insurance, and that is precisely for the reason I just mentioned above. You might be permanently injured, and that's not up for discussion. The issue is just how permanent and just how injured. Hopefully, I've been able to give you a better understanding around the different types of personal insurances there are on the market and their roles, and also made you think more about whether or not you should be getting some to help secure your family's future. If you have any more questions, please feel free to drop a comment below and I'll answer if I can. Thank you so much for watching, and I'll see you guys on the next one.